This is a quick introduction. This is a webinar about how to use a self-directed IRA to grow tax-advantaged real estate wealth. And we have a special guest here, is very knowledgeable on the subject. We've given this webinar 2 times prior, and it's always been one of the most popular, so we thought we would do it again. We is ABG Associates, which is myself, Ashley Garner, and Michael Crocifolio. We'll tell a little bit about ourselves, and then we'll turn it right over to Corey. So what we do, we invest in multifamily real estate, and we own it, we operate it, and in order to do that on a large scale, we offer opportunities to limited partner investors, and those limited partner investors provide capital, aka cash, and then we take that and we put it all together and we acquire these assets, and we own them and operate them, and then we share the wealth with all of the partners. So that's kind of it in a very crude nutshell. My name is Ashley Garner, and I have been in real estate my whole life. I grew up literally in the mom and pop version of what we're doing right now, in that my dad, when I was in high school, started buying old houses near a university campus, and we would internally subdivide them into apartment units and then rent them out to students. So I had a hammer in my hand, and that turned into the management and the financing and the legal, et cetera, and I kind of continued on that path. And in 2018, I bought my first multifamily property, which was a 10-unit property. And from there, we have scaled up to a 32-unit, a 35-unit, and most recently, a 196-unit property, which we purchased in February of 2025. And we're actively seeking a goal of 1,000 units. And so we are definitely actively seeking partnerships with limited partners as well. And I'll turn it over to Michael.
Yeah, hey everybody. Thank you for joining this afternoon. So as Ashley said, we're ABG Associates. I am the other half of that. I've been in multifamily real estate investing since 2019. I bought my first property. It was a 7-unit. And I like to say I was the accidental landlord. The classic, when you read the books and somebody's, inherited a property or something like that, they always call themselves an accidental landlord. I came about it a different way. So I came about it where my family was, we owned restaurants up in Pennsylvania. We were looking to expand and buy a small wholesaling operation that was an old abandoned restaurant. And abandoned restaurant, we were going to fix it up, operate it, and just run it as a business rather than, an apartment building. But then it just so happened that property had an unfinished apartment, 5,000 square foot warehouse out back, and 3 trailers that rented the land from us. And when COVID hit in 2020, roughly, the restaurant industry shut down, and I had no use for that particular restaurant for who knew how long it was going to be shut down. So we really had to pivot, and we pivoted into those rentals, and it kicked off a beautiful process where we started buying basically as much as we could, as fast as we could. We acquired about 35 units over the course of 4 years. And then I met Ashley back in 2023, and we kicked off the syndication journey.
All right. Good deal. Thanks, Michael. So this is a great webinar for y'all to learn about how you can use a special tool. So
all right, well, hello, everyone. Again, my name is Corey Deharsh. I am with a company called Advanta IRA, and I'm here to just teach you a little bit about self-directed retirement investing. So just a bit about my background. I've been with the company Advanta IRA since 2016, and I've served a few different roles with the company. So I started out learning the accounting back office. I came from a background working in banking and finance throughout college, and I have a degree in business management. And then I switched over to client account management very early on. That was technically what I was hired as. So I handled clients' day-to-day questions, concerns, transactions for about 5 years. So in that time, I processed thousands of different transactions and assisted clients with the IRS rules in several different unique various cases. And then about 4 or 5 years ago, basically in 2020, I moved out of state. I live in Charlotte, North Carolina now. Our company is based out of Clearwater, Florida. And I switched to the business development team. So now what I do on a regular basis are these types of educational webinars, networking, attending and speaking at conferences and various real estate investor associations, things like that, just to share with people the power and knowledge and information about these self-directed accounts. Not a lot of people know about them or know how to utilize them effectively. So I'm here just to make a topic that may have otherwise seemed too daunting or too tedious to you very digestible and understandable I do have what's called a CISP designation. That stands for Certified IRA Services Professional. I obtained that in 2018 and have done continuing education year after year to keep that certification in good standing. So for all intents and purposes, I am a very niche expert in the world of self-directed retirement account investing, and I have been for the greater part of the past. So my agenda for today is just going to cover basically Advanta IRA as a company, what we do, how long we've been around, what we're here to provide as a service to our client base, the basics about self-directed retirement account investing, the real gist of the rules and regulations, and then hyper focus into real estate as an asset class, various ways you could invest into real estate, various rules and regulations you should be aware of if you're prospecting deals or interested to learn more, and how you can use your retirement funds in real estate assets. And then I'll have a Q&A with everybody, and I do have a special offer at the end that I'll share with you as well. So basically, the company I work for, again, it's called Advanta IRA. We're a full-service, self-directed retirement custodian and administrator. We've been in business for over 21 years. We've got about 15,000 active clients and just over $3.5 billion in assets under administration. And all of our clients' funds that are not actively invested are insured in an FDIC institution. They're not actively earning for you while you're not putting them into a deal, but that money is safe and ready for you to activate and use into any investment that you bring to the table. Again, this is self-direction, so we're not providing any tax advice, legal advice, or financial advice. We're simply administering the accounts and keeping on the side of the IRS's rules, which is experts in, while you go out and find your deals, network with general partners, become a limited partner, go buy a rental property, things like that using your retirement dollars. And the other side of things that we do in our space to stand us above and beyond others in the self-directed industry is we pair each client with a dedicated client account manager. Again, that role that I served for 5 years is a role that you'll have assigned to you, a one-to-one go-to person to answer all your questions. You build continuity with this person, so you'll be able to ask them a question, and after a few times, either over the phone or exchanging emails, they begin to know how you interpret information and can effectively answer things for you instead of boilerplate in a very one-to-one capacity. So white glove customer service, educational content, and leading of industry costs. We're very cost effective as well as far as what we charge for our asset administration. So I pretty much referenced this on the last slide, but just a full disclosure, disclaimer, I'm here to provide educational information. I cannot convey any tax advice, legal advice, or financial advice. So with self-direction, it's very important and imperative that you do your own due diligence. You understand that we're not underwriting any deals for you or telling you what's a good idea or bad idea. We're simply making sure the deals you bring to the table as a self-direct investor fall within the IRS's guidelines, and then we facilitate the execution of that investment transaction for you and with you. So do your own due diligence, make sure you thoroughly know, like, and trust whoever you may plan to invest with before you get into any investments using self-directed funds. So the IRS rules regarding these accounts is really simple. A lot of people didn't know that self-directed accounts exist until they hear a presentation like this, but they've been around just as long as IRAs have been around in general. And what it is an administrator like us that is not a fiduciary or a financial advisor. So we simply follow the IRS's rules and let you invest into anything you want to, where most people have a fiduciary or a financial advisor administering their accounts, and they're limited to only letting you invest into stocks, bonds, and mutual funds. I hear all the time, people are with Fidelity or Charles Schwab or Edward Jones, name those big companies, and they say, oh, I have a self-direct account with XYZ fiduciary. But when I explain it to them further, that's not truly a self-directed account, because when you go to their quote self-direct option, what you really get is a drop down of 10 to 20 stocks, bonds, mutual funds that you can choose from. And those companies try to use marketing lingo to say that's a self-directed account. But in reality, a truly self-directed account is one where you can go and say, hey, I want to go buy this house down the street, or hey, I want to be a limited partner in this syndication deal. And that company lets you do it like we do. So just to break down a little bit more thoroughly, as far as the IRS's root rules on what you can and cannot invest to with a retirement account, it's real easy to tell you what you cannot invest into, and it's real hard to tell you what you can invest into because the options are so vast. The limitations are that you're not allowed to invest your retirement funds into a life insurance policy or a hard-to-value collectible like antiques, fine wine, artwork, anything that's subjective in value. Outside of those asset classes, you can pretty much structure a deal into any asset you would like, with certain limitations based on who you're doing the deal with, which is the middle bar here, prohibited transactions based on disqualified persons. And the next slide is going to show you in a very deliberate illustration who the disqualified persons are. But right here, I just want to set the precedent. You're not allowed to transact with a disqualified person. So I can't buy an asset from a disqualified person using my retirement account. I can't let a disqualified person be a tenant or benefit from an asset owned in my retirement account, effectively paying my retirement account back for whatever they're using, in today's case with real estate, the property for. So that's the rules with regard to the IRS and how they limit your use of these accounts. The other aspect here on the right-hand side of the screen is simply some little-known taxes that apply in certain investment scenarios. So for the most part, these are tax-deferred or tax-free accounts, depending if you're investing with traditional or tax-deferred retirement or Roth, meaning post-tax retirement dollars. So when you make an investment and it generates profit and proceeds, that money comes back into your retirement account, either tax-deferred or tax-free. Tax-deferred means you pay that tax later when you draw it out of your retirement account, when you physically retire in life or decide to start taking distributions out of your account. Separately, these two taxes that apply are either possibly UBIT or unrelated business income tax. That applies if you're making an investment that is not generating solely passive income. So you can make an investment into an active business, like let's say a laundromat or a car wash. And that business operates consumer good, fold and fluff laundry or a car wash with someone there to dry the vehicle off and do wax and things like that. That's some active income generated through a consumer interaction. So if you're making that type of investment, there may be unrelated business income tax that has to be filed and paid through their account. Well, specifically an application with state investing, if you're someone who's doing fix and flip real estate with your retirement account, you're certainly allowed to do so. There's just kind of a gray area with regard to your frequency of flipping houses. So there is no black and white rule, but our expectation and what we share with our clients is that the IRS, if they see you flipping upwards of 5 to 7 houses in a given calendar year through your retirement account, they may see that as you running a home flipping business enterprise through your retirement account, to which you may be subject to filing and paying the UBIT tax. That is the scenario. If you're going to be in that kind of bracket, we implore you to speak with your own CPA or tax preparer, get their best judgment and expertise on if you should apply and pay that UBIT tax. Now, the other tax reference here is UDFI tax, unrelated debt financed income. That comes into play specifically with real estate when you're making an investment into a leveraged asset. So whether you go out and buy a property with your retirement funds and you don't buy the property in full cash, you have to take out a mortgage in the name of your retirement account, which must be non-recourse lending. Whatever portion of that property is leveraged, you'll be subject to paying UDFI tax on it. Similarly, with syndication real estate, if you're looking to do a syndication investment through your retirement account, UDFI tax could trickle down to your retirement account. So it's important to speak with the general partnership team and ask them if they have a strategy or a plan, what you possibly could be looking at for UDFI tax that trickles down to your retirement account. A lot of times they'll have strategies. They'll set up what's called a blocker corporation and different ways that you can avoid the UBIT tax or mitigate the UDFI tax. But these are just little things that you should know about. We do a completely separate hour-long webinar on those topics alone. I just wanted to briefly touch base and outline that from a kind of 3,000-foot perspective. Now, getting back on track with the promised illustration of the disqualified persons, it's very simple. It's basically just the main trunk of your family tree. So if you think about your family tree and you cut off all the branches, aunts, uncles, cousins, distant relatives, those don't apply to disqualified persons. What applies are yourself, your spouse, your parents, your grandparents, your children, your grandchildren. So the lineal ascendants and descendants on your family tree. It also extends to businesses that those individuals own or control day-to-day operations of. So pushing back to the actual explanation here or examples, I'm not allowed to, as Ashley said earlier, buy a property in a town near a college I want to send my son to and let my son be a tenant in that property if it's owned by my retirement account. I can't buy my parents' house for them or from them using my retirement funds. I can't own a commercial property and let my wife's business be a tenant in that commercial property for her office, whatever she may be doing. Now, keep in mind, this is not extended family members. So aunts, uncles, cousins, even your siblings are not considered disqualified persons. So those people you are allowed to transact with. I could have my brother being the tenant of a rental property I own through my retirement account. That's pretty much the gist of the IRS's rules. Again, very sweet and simple when you apply what you can and cannot do and who you can and cannot transact with. And then from there, the power is in your hands to invest into various different asset classes. I already covered what a self-direct account is, but let me illustrate a little bit further for you what types of assets you can invest into. Again, it's very vast. We're here to talk about real estate specifically today, but outside of real estate, you can invest into paper assets. So whether you become a mortgage lender with your retirement funds or issue unsecured promissory notes to people that you know, like, and trust that you believe are going to pay you, you can do that. You can invest into cryptocurrency. You can invest into very unique assets. You can be a movie producer. You can fund a film project using your retirement funds. You can invest into cryptocurrency, as I believe I just mentioned, precious metals, so gold and silver, and much, much more. The options are very vast, like I said. You just have to know what you want to invest into, whether you have expertise or a specific interest in something, and then speak with your client account manager to figure out the appropriate structure to make that transaction or that deal happen for you.
Hey, Corey.
So yes.
Fatima had a question a couple slides ago. Is that
Sure.
blocker, is the blocker portion handled by the SDIRA custodian?
No, the blocker corp portion would be typically handled by the general partnership team on that side of things. The retirement account doesn't necessarily set up or handle blocker corps. That's on the general partnership team if they're working with something like that. The equivalent, if you will, to avoiding the UDFI tax from the retirement accounts perspective is that solo 401k plans are not subject to UDFI tax. So if I'm working with an investor and they know that they're going to make investments into leveraged assets, whether they're going to go buy a property and they know they need to take out a mortgage, or they're planning on investing into a syndication, and they want to their best ability, avoid the UDFI tax from the retirement account side of things, as long as they are a candidate for a solo 401k plan, my intention will be to set them up with that plan type. And that plan type specifically is for small business owners that are self-employed, have no W-2 wage earners, and intend to make contribution into that plan once they establish it within the first 2 to 3 years. So effectively, you have to know that you're going to generate self-employment taxable income. And I bring this up because a lot of tax preparers and providers, if you're a small business owner or self-employed, are going to work you through a strategy where you're writing off as much income as possible and possibly showing a net loss year after year. So you would have to work with them to make sure, okay, I understand I'm going to pay self-employment tax within one of these first 3 years after I set this plan type up and contribute something into this plan. Then you can have a solo K plan, and a solo K plan is not subject to UDFI tax. So that's how we would help a client avoid it from our side. Otherwise, the blocker corp is something that a general partnership team would establish as they're putting the deal together. Are we good on that, Ash?
Yes, she said amazing. Thank you. We do have another one, though. How does this apply in Puerto Rico law's jurisdiction?
I believe for the most part, Puerto Rico follows U.S. laws with the U.S.-based retirement account. It's not like the IRS has a subsection or subset of laws for IRAs held through Puerto Rican investors or assets that are being established in Puerto Rico, like a limited partnership syndication or something like that. So I think it applies across the board uniformly with whether it be an account holder that's living in Puerto Rico or an investment strategy that you may be looking to participate in that's taking place in Puerto Rico.
Gotcha. Okay, thank you.
Yep, no problem. Yeah, if any other questions come up, please feel free to interject. I'd be happy to get to them as we go. I should have some time at the end of the presentation as well for any other miscellaneous questions. So to the audience, please feel free to drop those. Always happy to take a little break and make sure you understand what I'm going through at the time I'm going through it, rather than holding your questions till the end. So back on track here with real estate assets. There's a number of different asset classes. So you can invest into a single family home, whether it be for short-term, mid-term, or long-term rental income. You can invest into mobile home units or an entire mobile home park. Condos or mixed use or commercial properties, and then syndications, like Ashley talked about at the beginning of the presentation, where you're a limited partner. So some other team, ABG Multifamily, is putting together this deal, and they're going to do the day-to-day operations, but they need to raise capital for that. So you use your retirement account after you review the deal, you like what they've got going on and what their plan and intentions are, and you put up your money. They do the deal, they handle all the day-to-day headaches and sweat and everything like that, and you get what's called mailbox money sent back to you. So profits and proceeds in the form of typically preferred distributions that are sent out either quarterly or annually or semi-annually. And then you usually get a lump sum payout once the deal goes what's called full cycle, meaning they've done all the project work that they wanted to do. They refinanced the deal or sold it to another end user or end group. And your initial principal usually gets returned as long as the deal goes well, with a little bit of bonus as well. And I've got a case study I'm going to cover, very rounded numbers, but an example of what that transaction looks like from a retirement account perspective. So I do want to just reiterate, people don't know self-directed accounts exist. It's really only 1% of the US-based retirement industry, and that's an industry that's got about $40 trillion in it right now. So hearing me provide this education to people or learning from a friend or a family member is a key source of people switching over to self-direction. It's a new source of capital for investment strategies you're already interested in partaking in. People are getting fatigued with the stock market, the roller coaster that has been the past few years, whether people switch over all their money to self-directed strategies, or at least break off a portion and diversify by making a self-directed investment or two, is the number two reason we see people switch over to self-direction. And then the third is the tax benefits. As I said earlier, when you're investing with this money, you're creating passive income and you're creating tax deferred or tax-free income. So if you bought a property with your savings and then sold that property, you'd be subject to capital gains. When you do that same investment using your retirement account, you are not subject to capital gains. You're just generating passive income with your retirement account. Now, the flip side to that I will be honest and direct with, is that when you make these investments with a retirement account, you're not able to get some of the tax benefits that you would get with your personal investment location. Essentially, you do not get to take advantage of those because you have to see it as your retirement account is a completely separate entity than you personally. So your retirement account making the investment. Yes.
Sorry, you glitched out just a little bit there. Start again on that tax benefits, how they do not, and then it kind of glitched out a little bit.
Yeah, no worries. Thank you for letting me know. So the tax benefits are different through a retirement account than through making a personal investment. So when you're making an investment with a retirement account, you do not get to take advantage of some of the tax write-offs and benefits that you would personally. Depreciation and bonus depreciation, things like that are part of your strategy if you're investing with your savings. With a retirement account, it's important to note it's two separate entities. So your retirement account is a separate entity than you personally. So your retirement account making an investment has the benefit of tax deferred or tax-free earnings and growth, no capital gains, things like that. Yourself making an investment has the benefit of getting the depreciation and the write-offs and bonus depreciation to lower your tax hit and impact for yourself personally filing taxes on an annual basis. So most of the retirement accounts that you're aware of can be self-directed. Most people are familiar with your standard traditional and Roth IRA or an inherited IRA if someone passed away and left you as the beneficiary to their account. But you can also self-direct education savings accounts or covered ESAs for young children in your family that you want to set aside money. You can take money out for qualified educational expenses completely tax-free. And you can grow by making these types of investments tax deferred and tax free. Health savings accounts. So if you're someone with a high deductible health policy, you can have an HSA account that you can self-direct into alternative assets. And then for small business owners, as I alluded to earlier with the explanation of solo 401k plans, we do offer solo 401ks as well as STEP and simple IRAs. Those are called IRAs. They're individual retirement arrangements at their core, but they are small business owners or self-employed plan types. So those are plans with a bit higher annual contribution than your traditional and Roth IRA. They only qualify for small business owners or self-employed individuals, and they are allowed to hold a mix of traditional and Roth or tax deferred and post-tax money in them. I've got here just
educational.
Yeah.
Do the educational plans include like the 529 plans in North Carolina?
It's comparable to a 529. It's not the exact same thing, but they're pretty much akin to each other.
Okay.
So it's not the.
It would have to be in order to self-direct it. It would have to be the ESA.
Correct.
Okay, gotcha.
So these next few slides are just a little bit more benefits and rules and regulations about the small business plan types. So SEP, simple IRAs, and solo 401ks, they're for small business owners. I'm not going to read through every bullet point on here because I pretty much alluded or spoke about it a few moments ago. Also, quick point that I can note, if you'd like a copy of today's slide deck, I'm happy to send a PDF to you. Just email me directly. I'll also shoot that over to Ashley and Michael so they have it if you reach out to them directly. But they're also creating a recording of this so you could watch it back as well at your own pace. These small business plans are a mix of an employee deferral of salary into the plan and an employer contribution or match of salary into the plan. And there's certain employees, given that, you have to allow to participate, or you can restrict from participating based on the number of hours they've worked or the resident status, whether they're a resident alien or things like that. So I'm not going to, again, read every single bullet point here, but just give you the gist of it. And you could reach out to me if you have further questions on these topics or strategies. There's no fiduciary liability when you have a self-directed account. So again, it's the same thing that I mentioned earlier. Never seeing what you choose to invest into from a good deal, bad deal, good person to do a deal with, bad person to do a deal with. As long as you bring a deal to the table, we'll make sure it falls within IRS rules, and it's up to you to choose how you want to do that transaction. These accounts are very flexible, so you can self-direct them. You can add a mix of traditional and Roth money into them. And again, with the solo 401k plan, you can avoid UDFI tax, not UBIT, not unrelated business income tax, but UDFI tax if you're planning to invest into leveraged assets. Another few benefits to the solo 401k plan is that you can take out a loan against your own 401k. It's called a qualified participant loan. You can borrow up to $50,000 or 50% of the cash value. There is basic terms. You have to pay yourself minimum quarterly payments back into the account. There has to be a 5-year maturity on that loan. And you do have to set the interest rate back to your retirement account plus or minus 1% of the current market prime when you initiate that investment or loan, whatever you want to call it. It's kind of both. Separately, you can establish what's called a ROBS plan, or rollover for business startup. So if you wanted to actually create a business and run a business through your retirement fund, you can utilize a solo 401k to do so. So basically, you set up a full 401k, you set up a corporation, and you issue private stock to that 401k for 100% units of ownership of that corporation. And then you own it through your retirement account. It's not the same as, again, investing into a car wash or a laundromat, as I mentioned earlier, as a limited partner. You're the full owner through your 401k plan of that entity. And again, that strategy is called a ROBS plan, or rollover for business startup. And the tax benefits I went over earlier, same thing. I'm just pretty much reiterating this a third or fourth time at this point. No UDFI tax with the solo 401k. So it's important to note to you guys that earnings are unlimited. Anytime you make an investment and it generates profits and proceeds, that's earnings generated by your retirement account. That does not count against your annual contribution, which you're eligible to make as long as you have ordinary earned income on an annual basis. With traditional and Roth IRAs, that's $7,000 if you're under age 50, $8,000 if you're over age 50. With 401k plans, it's about $73,000 to $76,000 that you can maximize. With SEP IRAs, $20,000. Simple IRAs, I believe, somewhere around $50,000. Education savings accounts, $2,000, and health savings accounts, depending if you have a personal or a family coverage ESA plan, it's, I believe, between $6,000 and $8,000. You can look at the exact numbers either from our website or just Googling the IRS's contribution limit chart.
Hey, Corey.
Yes.
Jamie had a question. Well, first of all, he thanked you for offering to share the slides, or she. And the question is it advantage to do this with a 1031?
So 1031 is a separate strategy that's very similarly aligned with retirement account investing. You typically cannot do a 1031 through a retirement account, but similar to what I mentioned earlier, answering your question about 529 accounts, 1031s are very akin and very similar to what we do with self-directed accounts. So it's not an advantage because it's not physically or technically tangibly possible to do a 1031 with a retirement account. But we actually do educational webinars with 1031 experts and intermediaries to kind of compare and contrast making the same investment through a retirement account versus making it with your personal money and going through the 1031 process. So while it's not the same, we're very familiar with 1031s, and we have educational content that I can point you to the direction of if you wanted to learn more about the compare and contrast of that. All right, so I'm going to break down real estate investing in the capacity of what it looks like when you actually do a transaction, and then have a few case studies for what transactions look like if you literally had an account with us and were to go through any of these processes. So when you're talking about buying physical real estate, deed of title real estate, not going to a syndicator as a limited partner, I want to go buy a rental property. The property itself is being purchased by your retirement account. So the deed of title is going to be taken in the name of that retirement account. For example, Advanta IRA for the benefit of John Doe, IRA number 1234567. All of the funds for the closing need to come out of your retirement account, or if you partner with others, through the various partners. And the ownership percentage that goes into that property on that deed of title is going to be 100% based on the dollar amount brought to the table against that final settlement statement or Alta HUD document. So it's important to note all of the expenses and all of the income generated by that property or due for that property need to go by that ownership percentage. So if you're doing it 100%, and you need to put a roof on the property in 2 months after you buy it, you need to make sure you have enough to buy the property and afford that roof before you start generating some passive income back into the account with the retirement. Separately, if you're partnering, when one partner doesn't have their money to hold up their end of that roof expense based on the percentage, so $10,000 roof, 75-25 split. If you put $7,500 in your retirement account to cover your 75% of that roof expense, and your partner with 25% doesn't have $2,500 in their retirement account or cash on hand to pay, technically speaking, your hands are tied. You shouldn't be having anyone cover or reimbursed for that aspect. So due diligence wise and underwriting wise, make sure you have a full forecast of what expenses may come to play with this investment start to yielding income. And then also the income is split based on that ownership percentage. 75-25 split, you generate rounded number $1,000 a month in rental income. $750 comes into your retirement account. $250 goes to your partner that's 25% owner in the project, whether they're an individual, whether they're a retirement account, whatever it may be. When you have expenses like your utilities and things like that, it's very easy to set it up on our portal for the expenses to automatically come out for you. So with your routine and regular expenses, you can have an automatic authorization on file. And those utility providers typically send the invoice directly to us as your administrator. So as long as you have the cash in your account, we'll go ahead and cut that payment out and send it out. If you have one-time transactions, you can log into your portal 24/7 or email the payment authorization letter to your account manager, and we cut that payment out the same or the next business day and get those vendors paid. You obviously, because it's a payment due for your retirement account, you have the right to go on property and inspect the work and verify it's done up to your standard before you remit that payment. But what I do want to share with you is that the disqualified rules for disqualified persons come back to play here, because you're not allowed to conduct any wet equity on behalf of the property, meaning you can't be the one on site painting the walls, changing the flooring, putting a new roof on the place, anything like that. Even to the example that the IRS doesn't want to hear that you change a light bulb in a property owned by your retirement account. All this should be done by non-disqualified third parties. That does not stipulate that you have to go get a licensed insured plumber or electrician. You can just work with a handyman that you're familiar with, but they cannot be a disqualified person or yourself in order to maintain this property through the IRS rules and regulations. As far as renting the property and generating income, it's completely up to you how you set that. You can, again, as I said earlier, short-term, mid-term, long-term. You could list a property on Airbnb or VRBO. You completely set the terms, whether it be the duration, the rate, who you want to be a tenant. You could use third-party systems and processes like HUD and Section 8 if you want help with vetting tenants out and subsidizing their rent, making sure you're getting paid. We see clients do that all the time, but it's completely up to you. We're not overseeing and say, oh, you need to charge more, or you should charge less to get your vacancy rates where you want it to be, or anything like that. This is completely up to you as a self-directed investor and how you want to maintain and process through this strategy. Real quick as well, you can employ a property manager if you want to. That'll take some of that headache off your plate. But it's important to note, property managers are typically going to charge you 10 to 12, maybe 15% for property management services. So while you can certainly serve as a de facto property manager yourself, you may not want that additional headache and may just want to off-service that type of thing to a property manager. But there's no absolute need or requirement to do so. It's completely your discretion. So a quick case study on making a real estate transaction using a retirement account for rental income. So I've got a gentleman named John. He finds a property that he can purchase for $200,000. He sets up a self-direct account, gets the money moved over from his current account, and facilitates the closing transaction with his account manager. So everything's dotted and crossed in the name of the retirement account, the closing handled, completely by the account manager, and we buy the property in the name of this retirement account for $200,000. John, sorry, I thought I had a second slide on this one. John decides to rent that property out for 2 years and generates rental income for 2 years, whatever dollar amount that could be. Let's just say over 2 years, he generates $30,000 of rental income. And then he sells that property for $250,000 after 2 years. So that's $30,000 of rental income generated over 2 years, plus a $50,000 bump when he sells the property. That's $80,000 generated. That's tax deferred or tax-free earnings going back into his retirement account. There's no capital gains to be paid on that. He then has $280,000 to invest into his next property or whatever any other project he wants to do. Now, a few other ways to invest into real estate through an account like this are by syndication, by private lending, or by joint ventures. So syndication, I'm going to cover in my next example, case study and slide. But private lending is, as I alluded to earlier in the presentation, you issuing a promissory note or a secured loan like a mortgage using your retirement dollars. So you can have an investment loan, you can secure it by the property someone's buying, and actually be a physical mortgage lender instead of a bank to someone that you want to issue a loan to. You can also do an unsecured loan. So someone that you really know, like, and trust, you can issue them a loan, set the interest rate, set the terms, and really just have a piece of paper that says, I owe you this amount of money. Now with that, it's very tricky because if they default on an unsecured loan, you don't have any recourse to go after them for anything else. And then thirdly, with joint venturing, that's a strategy where someone brings some sort of asset to the table, someone else brings another asset to the table, you do a real estate project, when you sell it, you split the profits and proceeds. Again, we have no jurisdiction on how you set this up. So let's just say you go buy a piece of raw land with your retirement account and you joint venture partner with a construction firm or individual that can actually develop the property. And then you decide to split the profits and proceeds based on any discretion that you guys have. Or you have a partner with property and you have cash in your retirement account and they don't have the cash to develop the property. So it can go either way. It's a strategy where, again, you're in full control. You set the terms, the rate, the joint venture agreement, how you're going to split the profits and proceeds when the deal is done. It's very unique and also vast in the form of different ways you can structure it.
Hey, Corey, Jamie Hickman has a question regarding property management. So she wants to confirm that property management does not qualify as sweat equity. Is that right?
It's not that it doesn't qualify. It's that you cannot be a property manager in the sense of you can't do any sweat equity yourself. So you can serve as a de facto property manager just by coordinating and facilitating these non-disqualified third parties doing work and labor at the property. But you yourself or disqualified persons to you, your parents, your children, your spouse, are not able to, if it's a short-term rental, go in and flip the property before the next tenant comes in, change the bed sheets, clean the linens, restock the pantry, things like that. You're not allowed to do that. So if you need someone to do that, you can have a property manager, you can hire a handyman or a third-party service, but you and your disqualified persons are not allowed to do that.
Gotcha.
So a syndication deal. So this is alluding to exactly what Ashley said earlier that he and his team do at ABG Multifamily. So we've got Rebecca, who's got money in her retirement account, and she meets a gentleman named John, who's a general partner in a syndication team. John brings up to Rebecca this deal that they've got going on and the possible great returns they have to offer. And he provides Rebecca what's called a PPM, a private placement memorandum, or a prospectus, which is basically a packet that tells you exactly what the property is, what they're raising for it, how they're planning to use the money they raise, what their exit strategy is going to be. Anything you could want to know or need to know about this deal should be included in that PPM or that prospectus. So Rebecca reviews it. She decides she does want to make an investment. And the minimum investment in this case is $50,000, which is a reasonable dollar amount. A lot of times it's 50 to 100, 200. You really just at a case-by-case basis on the general partnership team, what they're looking for from a minimum investor standpoint. Sometimes they require accredited investors, sometimes they do not. That's kind of on the client side of things to figure out where they fall in that and how much they're willing to invest. But Rebecca, in our scenario here, decides to invest $50,000. So she gets a self-direct account set up. She sends the subscription portion of the private placement memorandum to her client account manager. He gets that, or she gets that, approved by Rebecca, executed in the name of Rebecca's retirement account, and funds the investment transaction, typically with a wire, over to John's team for the deal to be placed. Now, this is where the mailbox money comes into place. So On an annual basis, there's an 8% preferred distribution returned on this $50,000 investment. That's $4,000 a year. After 5 years, which is a reasonable time frame, 5 to 7 years roughly for a syndication is what we see on average. Could be shorter, could be longer. The deal gets refinanced and otherwise goes what we call full cycle. And Rebecca gets a lump sum payout of $65,000. So in total, for making a $50,000 investment and having her money kind of placed there for 5 years, she's generated $20,000 in preferred annual distributions. That's 8% or $4,000 a year, and a $15,000 bump as well, because the project in this scenario went exceedingly well up to expectation. It just went off without a hitch. So that is $35,000 of income that was generated. And that money goes back into the retirement account. There's no capital gains. There's no other taxes that need to be paid on it then. If it's a tax deferred account, then that money will be taxed when it's distributed out of the retirement account later in Rebecca's life, and she could reinvest it however she wants to. Now, case study I've got here. Yes,
just to confirm on that. So if they invest in the syndication, then any kind of funds that or any returns, distributions periodically or at the end on the full cycle event, that all goes back into the self-directed IRA. It doesn't go directly to the individual, correct?
Correct. And that's a very important distinction. In any of these investment scenarios, as I said earlier, you're making an investment with your retirement account, not yourself personally. So for you to have any personal touch of that money, it needs to first go back to the administrator, in example, Advanta IRA. And then you need to tell the IRS, I am drawing this money out. I'm taking a distribution out of my retirement account because I want to utilize this money for personal purposes. There is no way, shape, or form that you're allowed to touch it before it flows through the retirement account administrator, gets reported or documented to the IRS that you're taking it out of the retirement account for a personal purpose. It always has to go directly from the investment you make back into your retirement account directly. And then whenever you're ready, typically people wait until at least after 59 and a half, which is the age where the IRS stops levying a 10% early withdrawal penalty for tax deferred accounts. That's when you initiate the distribution and start drawing on that money. You could take it earlier than that. Just be aware there's a 10% early withdrawal penalty with tax deferred money. If it's a Roth account, the early penalty is a little bit different. The rules for that is different, and that's its own separate webinar and content as far as the IRS rules for distributions out of Roth accounts. All right. So private lending. I'm going to just give a brief example of a private lending scenario. So we've got a gentleman and a woman that neighbors in their community. They network together, whether it be at their local chamber of commerce or something like that. People know each other. And there's a woman that wants to start a coffee shop, and there's a man that's got money to invest in it. So they talk about different structures. He could invest as a private stock owner in the coffee shop using his retirement account. He could invest by issuing a secured loan or an unsecured loan to this woman or to the entity she sets up as a coffee shop. And in this scenario, we're just going to go the easiest route possible, which is a unsecured promissory note issued to the woman or to her coffee shop entity in the amount of $100,000 at a 10% interest rate with a 12-month maturity. So what happens is the loan gets funded out of the retirement account, payable to the borrower, which is this woman, Sonia, or whatever her coffee shop is named. There's 10% earnings on this, so $10,000 generated, whether that's a balloon payment at the end or monthly payments, however that's structured. And the loan is paid off after 12 months. The retirement account earned $10,000. Sonia didn't have to go to a bank and get a higher interest rate or anything like that. And it's a very sweet and simple transaction. We see this a lot when people are invested in their community and trying to help out someone start a business. I did something very similar after college with a friend that was trying to get a business started out. But this is something you would typically do, at least in the unsecured loan capacity, with someone you very, very much know, like, and trust. Because again, if Sonia were not able to pay the money back to David's retirement account, it's a non-recourse loan. It's an unsecured promissory note. So there's no security instrument he can collateralize or has collateralized to go after if she defaults on payments. So additional strategies for people that are trying to invest with limited funds. So let's just say you want to be a real estate investor, but you don't have $100,000, $200,000, $300,000 to invest into a syndication or to go buy a rental property. You can invest as a mortgage note or lend people money to do fix and flips on their own projects or properties. You could partner with people. You can utilize leverage, so non-recourse lending which again is going to be subject to possible UDFI tax. You could do tax deed and lien investing, which is a very low barrier to entry strategy with very high upside in returns if the tax deed or lien investment you make works out as a slam dunk or grand slam type scenario. And then real estate options contracts are essentially wholesaling. So I find a property valued at $150,000. I get it under contract with a $2,000 escrow deposit. I have 30 to 45 days on average to go resell the contract to buy that property for $150,000 to someone else for at least more than the $2,000 escrow deposit I put down using my retirement account. So let's say I find a distressed property, I get it under contract for $150,000. I spend $2,000 on that escrow deposit. I go sell it to another investor for $3,000. Generated $1,000 in my retirement account. That investor gets to buy this property at $150,000 instead of $170, $180, $200, whatever it may have gone for if I didn't lock in that contract. And all I spent was $2,000 and returned $1,000. Takeaway points I want everyone to walk away with. It's very important to determine the best plan type for your needs. And it's really easy to complete an application. Our application takes about 10 to 15 minutes. We get the account open. It takes about a week to a week and a half on average to get the account funded, and you can start investing into any asset you want to from there. Even if you have on day one of opening your account, the paperwork for the investment you want to make, we can get that all underway and executed so that by the time your money gets into us from the transfer you're making or the rollover you're making or the new contribution you're putting into the account, we're ready to go and fund your investment transaction. You're funding the investment at your own discretion. There are endless strategies and opportunities. It's always up to you to do your own due diligence, build your own team of CPAs, tax preparers, attorneys, so that you're doing thorough due diligence, because there's no fiduciary overseeing you when you're doing a self-directed investment. You're essentially taking the risk and the control in your own hands as your own fiduciary when you're making self-directed investments. And finally, all the income and all the expenses need to flow in and out of this retirement account directly. The money does not touch your personal hands for any personal purpose until it goes through the appropriate channels, as I outlined earlier, answering that question that came in from the audience. We put out a lot of educational content, so I do webinars like this, and the rest of my business development team does 2 educational webinars like this a week, typically every Tuesday and Thursday. You can go to Advanta's website and look at our events page and see what we've got coming up as far as topics and guest speakers. We also have a podcast called the Alternative Investing Advantage Podcast. You can find anywhere you find your podcast otherwise. My colleague Alex Perney hosts that, and it's a great conversational piece with experts in various investment industries. It's not as strictly educationally driven. It's more of a free-flowing conversation talking about various aspects of investing. And we have a blog on our website as well if you're interested in my own words, the nerdy industry news about retirement investing in the self-directed space. You can check out our blog. Applications are really quick and easy to complete. Getting your account open and funded takes roughly a week to a week and a half. And then investing is at your discretion. Find your own investments, do your own deals, whatever you want to do. The power is yours when you're self-directing. Any other questions that may have come in from the audience or that you guys may have been holding on to? No question is too silly, too small, or too stupid. So just let me know. Trust me, I've been doing this for 9 years. I can answer mostly anything you may want to ask, or I may have to defer based on the structure of the question to speaking with your own CPA, tax preparer, or of the like. But I'll leave my contact information here on the screen for a minute. Yeah, so our fees, I alluded to this at the very beginning of the presentation. They're very competitive. I know this call is being recorded, so it's going to be out in the ether for perpetuity. So I'm not going to say a specific dollar amount, but it's only a few $100s that our clients are billed on an annual basis. If you want the fee agreement, you just have to email me. I'll send you the PDF of the fee agreement. We have not changed or updated our fees in the 9 years that I've been here. For the most part. So it's very cost competitive. You're only looking at roughly about $300 a year with us. And that comes with industry leading customer service, as well as industry leading educational content from your administrator.
Okay. Thank you.
You're welcome.
I'm sharing the link to your learning center right now in the chat. And
Awesome.
For those of you, you can get to their YouTube channel from there, but they have a lot of great videos about all kinds of different things. One of the things that blows me away about this topic is really how many options you do have, how many things you really can do that it's crazy that so few people know about it. In fact, we didn't even know about it before maybe a couple years ago. And we've had great experience with investors in our projects using their self-directed IRAs, and great experience with those investors using Advanta and Corey to facilitate it. It's a very efficient process.
I appreciate that vote of confidence, Ashley. And as Ashley just alluded to, and I said earlier, not a lot of people know that this is an option or opportunity for them, but people have the money or have the interest in making these types of investments. So it really just takes hearing an educational piece like I've done, and then maybe having a follow-up call with me to figure out what your needs are and how I can help you. I am in sales, obviously, but the last thing from a used car salesman or pushy, I really want to just help people from a financial literacy standpoint. And after that conversation, if it's not a good fit for you, at least you'll walk away knowing that I gave you some good information. You can speak with your friends, your family members, whoever else may be interested in learning more. And for me, at least, business-wise, has done better that way than getting you on the phone and trying to force feed an application down your throat.
Corey, I think you've answered this. I think the answer is very, but Jamie said, how competitive are you with other similar companies?
We are very competitive. As I said earlier, we charge on average a few $100s a year to our client base. That same account type, there's companies out there that charge close to $2,000 for the same type of account and same type of use case and things. There's companies that know what our fees are and undercut us by $5 to $10 on average per increment. But the thing you want to keep in mind is, yeah, you may be able to save $5-10 a year, but what are you compromising as far as the level of customer service, the level of education and expertise from the administrator you're going with? Because we see people all the time that I'll touch base with. They'll be interested in setting up an account. They go radio silent, and I finally get a hold of them. They said, "Oh, I went with this company because they were cheaper than you guys." And lo and behold, more often than not, 2-3 months down the line, they come back and say, "Oh, I shouldn't have done that. I could never get a call answered. I could never get my questions answered. I got conflicting answers. I was calling a huge call center and didn't ever speak to the same person time after time." So we are very competitive. I'm more than happy to email anyone a copy of our fee agreement. I just, again, because I know this webinar is being recorded and is going to be so forth, put a timestamp or give the exact dollar amount out here on a live presentation.
Okay. And one more question here. Can a non-U.S. citizen who doesn't live in the U.S. buy their first mortgage as an individual, or do they need to create a company to invest in through the U.S.? So you may or may not be able to touch on that.
Yeah, I think at least the way that question is worded, it's a bit outside of my scope. So let me apply what I think that person was asking to an answer that I can provide. So as long as someone has a US-based tax ID or social security number and are eligible to have a US-based retirement account, they can live internationally. So we have clients that are residents internationally, but also have US-based retirement accounts, and thus can transition those accounts from fiduciaries to self-directed accounts and make investments, whether it be domestically or internationally. We see clients invest into real estate, whether it be physical domiciles or syndications that take place outside of the US. As far as that goes, the IRS doesn't restrict where geographically you invest. It's more so the area that you're planning to invest into. So there's certain countries, Costa Rica, for example. I've got clients that invest in Costa Rica pretty frequently. Costa Rica will not let a US-based retirement account be the owner of title of property in that country. So if someone wants to buy property in Costa Rica, what they first have to do is set up the Costa Rican equivalent of an LLC, fund their retirement account into that Costa Rican equivalent of an LLC, and in the name of that entity, buy the property in Costa Rica. It's always a case-by-case basis on the jurisdiction and municipality and region that you're planning to invest into. But again, the root of an answer that I think goes to that question that was asked there is, as long as you have a US-based retirement account or have a US-based social security number or tax ID number to which you're eligible to establish a US-based retirement account, you can be an international citizen and create, contribute, transfer, roll over into one of these plan types.
Great. All right. Thank you, Corey. By the way, Allison has posted in the chat the contact information for Michael and for me. And Corey's contact info is on the screen right now. Corey, if it's okay, I'm going to jump over and share our current offering, so people can see a real life example of what some of our mutual clients have invested in. And so if you're interested in that, stick around. And
I just stopped sharing my screen, so you should be good to do.
Okay. All right, great. Well, I know we've been on here, for a while, so I'll make this brief, but I just wanted to show you this because this is something that real people have invested money into by using Corey and his firm to do it with. And so this is the property that Michael and I at ABG Multifamily purchased back in February. It's in Jacksonville, North Carolina. It's 196 units. And what you're looking at is, the pitch deck, if you will, but it's the explanation of our opportunity. And so it's pretty thorough. I'll skim through it and show you the highlights on how it works. So fees like sponsors like Michael and I, we collect fees. So acquisition fee, asset management fee, and a capital transaction fee. And then there's an ownership split. And in this case, the ownership split is the investors, like some of you, own a cumulative 80% of the whole ownership. And then the general partner, which we call Class B shares in this case, would be Michael and I and our small team. And, we bought this place back in February. We've been working on it physically and operationally ever since. And we have achieved all of our business plan goals that we've set out to achieve. And that includes things like, sprucing up the property, the landscaping, et cetera. But it also includes things like reducing our overall insurance expense, our payroll expense, things like that. It includes getting out any tenants that weren't performing and making sure that we fill it back with tenants that meet our credit criteria and become good residents. We've also been working on the refinance to a permanent source of debt from our bridge debt that we bought it with. And one very interesting thing about that is that we purchased this property for $21,250,000 in February. And about 3 weeks ago, we got our new appraisal in for the refinance, and it's already increased in value by about 17%, which takes the value up to $25,400,000 in, a matter of months. And that's due to the work that we did that I just explained. So our business plan here is to go ahead and close on that permanent refinance, which will increase our monthly cash flow by a significant amount and continue to drive the value. So notice then our debt service payment will remain the same, in this case for 35 years or as long as we hold it. And so we have all of the gravy, if you will, to collect by decreasing expense and increasing revenues. And then we will exit this through a capital event, just like Corey said. And that will either be that we sell the property or we refinance it, either way, giving the investment back to investors. And if we sell it, then, you get your share of the proceeds from the sale. So that's generally how this stuff works. Michael, jump in anytime if you want.
Yeah, no, you covered it.
That's rare. Michael usually catches me in many omissions. So in this case, somebody in the chat asked, is $100,000 enough to kind of start your real estate investing career? And the answer is absolutely yes. In this case, our minimum investment is $100,000. And we've had, like I said, several clients go through Corey in various amounts, 50, 100,000. Our highest investment actually that's in this property is $700,000. And Michael, is that also through a self-directed IRA?
Yes, it is.
I think it is. Yeah, I think it is. Yeah. Okay, so that's that. So the answer is yes. You can get in with up to $50,000, and this is just a little summary of, again, the things that we've done to the property to improve it that I kind of ran through. If you're a numbers person, we've got lots and lots of numbers, and I know you can't read this on your screen, but this is basically the 5-year pro forma of what we expect it to do. The interesting note here is that we're already right on track with that. So a lot of the risk is gone from this investment since we already own it and we've already implemented the business plan improvements. Michael, we had a property management meeting on this property on Monday, and remind me the occupancy that we've achieved so far.
Yeah, the occupancy as of Monday was now at 99%. So 196 units, we're sitting on 2 vacancies.
Yeah. So it's hard to do. It's hard to do much better than that. As operators, we're thrilled with that, of course, but it also indicates to us that now's the time that we possibly can, tweak our offering, if you will, to the tenants and increase the gross revenue. So you can already start to see where we kind of pull away because we'll have that fixed rate debt, and it's really powerful stuff.
Hey, Ashley, we've got a question from the chat here from Jamie. A couple of questions built into one. So first, do you charge a carried interest? Is it audited? What is the purchase price of the property?
Well, the purchase price of the property was $21,250,000.
Yep.
And we've already purchased it. What was the second question,
So the first question was, do you charge a carried interest? That answer is no, we do not charge a carried interest. And is it audited? Yes. So we just submitted this for HUD approval, which is a very, very rigorous loan process. And we have audited financials from a CPA firm that is supporting this.
Great questions, by the way. So the slide that's up there now, this is an example of if you invested $100,000, that blue number in column 1, we can play with that number. In this case, we used $100,000 for the example, but it basically breaks down all of the ways that we are projecting that limited partners will get paid. And if you look over here at the end, total return and investment, 127%. That's $127,000 on a $100,000 investment. So it's important to note that if you put in $100,000, you get your $100,000 back, and then you get an additional $127,000 on top of that. So really, if you put in $100,000, you get back $227,000. If that makes sense, it's important to note. We're projecting periodic returns. In this case, with the HUD loan, it's actually sometimes we do quarterly returns. With the HUD financing, it's 2 returns per year, but same amount of money that we're projecting. And then overall, an internal rate of return of 19% or higher, and an average annual return of 25%. And that average annual return, basically, if you take the whole return over the whole life of your investment and divide it by how many years it was in there, that's how you get that average annual return. Those are very good numbers, by the way. Everybody has their own criteria on what they want their investments to do. But as far as multifamily investing goes, those are good numbers. And this property, it has all the things: a swimming pool, dog parks, storage units, freshly renovated laundry room with brand new equipment. It's a nice community type park-like setting. And there's a picture of the amenities. Office, we have a gym. These are some details on the property. And then, this talks about the Jacksonville area and where specifically the property is located. Like we said I think we said this, but if we didn't, it's okay. So Michael and I are the general partners, and then we have teams of vendors that we use, third-party property management and third-party CPA/CFO. And then we have a very experienced niche attorney that works for us on all of our real estate transactions. And it's a great team. It's very efficient. This slide is kind of an interesting slide, but it indicates the value of that $100,000 investment, because 2 things have changed since the beginning. Number one, we set out to raise $8 million, and turns out that we only need to raise $6 million because of the financing and some of the other things that we've been able to achieve. So your slice of the pie is larger than it would have been if it was an $8 million total raise. Then you have this size of pie. But if the pie now goes down to only $6 million, then your slice of the pie increases in size. Also, I mentioned that appraised value, that's a very significant increase in value from purchase price. And so we've already achieved a great addition to value we're proud of. And that one, so this is another way that y'all can stay in touch with us. Our website is abgmultifamily.com. We also have a channel on YouTube where we make videos a lot like Corey and his team do, and we put them out just for general education. And then our phone number, my phone number is there at the bottom, and my email address, and then Michael's is on the chat if anybody wants to see it there. And that's about it. Does anybody have any more questions about that specific offer? Now, by the way, I kind of left out. We have we're still accepting investors into this deal. So this is something that you could set up an account with Corey, self-directed IRA, send it over, send your investment amount to us. Corey knows how to handle our paperwork. They've already done it several times. And it's a nice, smooth way for you to get into real estate and diversify your portfolio a little bit. And in this case, it's really special because a lot of the risk is already gone from this investment since we've achieved a lot of goals already. So we have, maybe $500,000 left room, something like that, Michael?
Roughly.
Yeah, something like that. So it's not much, but we do have room. If anybody wants to talk offline and get involved, we'd love to have you. And looking in the chat.
Yeah, I just posted in the chat before anyone leaves. I forgot to mention at the end of my presentation, a special offer that I alluded to in my agenda slide. Anyone that reaches out to me to set up a new account, whether it be because you saw me here on this presentation or you specifically want to invest with ABG multifamily, I will be able to waive our standard application fee. So reach out to me directly at Advanta IRA, reference ABG multifamily or this presentation today. And if you do set up an account, I'll be able to waive the application fee. If you're one of the people that ask me about the fees in general, just shoot me a message and I will email you the PDF of our fee agreement, and I'll be happy to set up a time to speak about any questions or concerns on that fee agreement you may have. Sorry about that, Ashley. Thank you.
No, I'm glad you brought that up. I see a couple of things, and I was actually going to ask you about that because I remembered you mentioned your special offer, so I'm glad you came back to it. There's one question: how long do you need to keep the money in the investment to meet the requirement? This is, we're projecting a 5-year hold. That's another thing about real estate investing, and especially in syndications, that it's not a liquid. This is not, real estate's typically not a short-term, quick in and out type thing. Michael mentioned in his comment, we're planning on a 5-year hold, and that's the business plan for this one. We may sell it before 5 years, or we may sell it after 5 years. We may decide to refinance it in between and give you your money back then. So the key is that if you invest in something like this, you need to be prepared to leave the principal of your investment in the investment, at least for the amount of the business plan, which in this case was 5 years. But it's a great question. And Fatima, thanks for your compliment on this is a home run. We agree. We think so too. And it's, knock on wood, but it's performed exactly the way that we had hoped. So thank you.